Okay, so for number one, the statement that your friend made is wrong because your friend is referring only thinking about the gross profit before any expenses are taken out, such as like taxes and overheads and interest payments that you need to make. So the real profit being made is known as net income, and that's the total profit after subtracting out those expenses and depreciation. For number two, gross refers to the total amount made as a result of some activity. It can refer to things such as total profit or total assets. Net refers to the amount left over after all deductions are made, so subtracting out depreciation and amortization and property, plants, and equipment. So net income for a business refers to the profit after all expenses, overheads, taxes, and interest payments are deducted from gross income. For number 3A, so if you're franchising, you'll have more accounts receivable, whereas if you own, then you'll have more accounts payable and more PP&E. On the asset side, because for example, the Cheesecake Factory has to invest all of its own equipment, it has to invest in all of its own equipment because they own. This is why more is tied up in PP&E. But for Jamba Juice, it's franchise, so instead it shows up as on the business owner's balance sheet. For 3B, an example of someone who franchises are places like Jamba Juice, IHOP, McDonald's, and this means they own the name and the privilege of having that name and using another firm's successful business models. So you own the business and sometimes the property, but not the name. And it could be looked at as like a pimp and hoe relationship. On the other hand, places such as Cheesecake Factory, Kimpton, Personality, In-N-Out, those are all owners and operators and have to master each individual business component themselves. But they can also have the freedom to take their business in any direction they want to, which a franchise doesn't have that option. For 4A, there are two occupancy expense lines, and this is because McDonald's has two separate parts of their business. One, which is what they own and operate, and their own chains, and one is where they franchise and own the buildings. So one of them shows the fee that they pay for the company being ran, and the other is the fee for the franchise. For 4B, McDonald's makes more money as a landlord. It does not make more money off of burgers. You get this by comparing the earnings to the costs. So if you subtract the expenses for each kind of business, like between burgers and being a landlord, pretty much, you end up spending more money for the burger business, but making more as a landlord. Okay, thank you.